Coming up today, why Nvidia jumped 8%, inflation keeps cooling, oil finds support in the back of Hurricane Francine, the market's reaction to the presidential debate, and another Fed member gets caught with his hand in the cookie jar. Let's get it, guys. Welcome back, everybody, and what a wild ride in financial markets it was overnight into the early morning session. E-mini futures were selling off in the midst of the presidential debate last night, along with Bitcoin, as the market's perception was that Kamala Harris won the debate. However, stick with me today, and we'll do a little fact-checking on the other side, along with showing you how betting markets and financial markets have reacted to that debate. And as you can see on the daily candle here, it was quite a wild ride. S&P 500 trading over 150 point range, high to low, finishing above 55.50. Now getting a bit of a bump up the front, and just looking at my main technical chart on the SPY, going down to a 5-minute chart just to show you the wild ride the market had here today. We had CPI come out before market open, pretty much came in line as expected. I'll show you more on that in a minute. Market sold off swiftly, at one point getting down over 1.5% before 11 a.m. New York time, found a bottom and just ripped up right into the close in a parabolic fashion. So it looks like there was some money just waiting there on the sidelines, ready to scoop up that dip. And that was led by the Nasdaq today, finishing up over 2%, reclaiming its 50-day average. And that was thanks mostly to semiconductors, key sector I've been watching lately, led by Nvidia, up over 8% today. We also saw ARM Holdings up over 10%, Supermicro Computer having a bit of a bounce off these really weak levels. There's a look at AMD, getting back above its 50. Strong move up for Broadcom, along with Taiwan Semi. Intel still trying to find a bottom here, $19 a share. And this was a bit of a continuation after yesterday's big move up in Oracle, and founder Larry Ellison coming out really bullish on AI, speaking up the huge demand and need for data centers. Said there's still at least another 5-10 years of explosive growth in AI infrastructure, and that real players need to spend $100 billion if they want to compete. We also heard today from Nvidia CEO Jensen Huang at the Goldman Sachs conference, discussing the return on investment of AI infrastructure, which is a bit of a worry point amongst the market. All these hyperscalers spending a lot of capex on AI. Investors are worried, are they going to get a return on all that investment? And if so, how long? So he seek to quell those fears. And he said his customers have never been as hungry as they are now for more compute power, reinforced the efficiencies it does drive for companies having these advanced GPUs. So they are way more cost efficient, and that the return on them is fantastic because the demand is so great, and that investors need to take productivity gains that are unlocked via Nvidia's GPU systems into account. Also, interestingly, he said, I think the days of every line of code being written by software engineers, those are completely over. And once again, we're getting a lot of comparisons between Nvidia now and Cisco in the late 90s. Cisco was the picks and shovels provider for the internet infrastructure and hardware and networking equipment, whereas Nvidia is the picks and shovels provider in the AI boom. However, the main difference being Cisco's valuation got absolutely crazy, really diverged a lot from its earnings per share, whereas Nvidia has pretty much been tracking its earnings per share over the last couple of years. In fact, Nvidia has a better valuation now than it did a couple of years ago. And that's because its earnings and revenue, along with its operating margins, have all exploded in that time. However, we've got Morgan Stanley's chief investment officer saying the AI theme is overcooked and investors should take shelter in quality defensive stocks. And that's Morgan Stanley's Mike Wilson, who said some of the luster has come off the AI trade, and Wilson says investors are now taking shelter in defensive shares as they wait for new themes to emerge. He sees plays in sectors like utilities, consumer staples, and healthcare. And that's true, it has been the case for a couple of months. Whether that continues on is another question. Really hope Mike Wilson can turn his track record around. The last couple of years haven't been so great. He did just come out a few weeks ago and told us that we're not going to see a bear market, which got all us investors a little nervous. But moving on to Goldman Sachs, they said there's a corner of the stock market that's set to outperform once the Fed starts cutting rates. And that's the often under-discussed and overlooked area of mid-cap stocks, in which Goldman says they're poised for greater growth than small and large caps, as they have lower starting valuations to larger caps and have stronger fundamentals than small caps. With mid-cap earnings expected to grow 11% annually over the next 2 years, they have stronger balance sheets than small caps, better profitability. Now you've got to keep in mind the Russell 2000 is full of a lot of unprofitable biotech company, kind of skews the index as a whole. However, that's not to take away from Goldman's mid-cap call. You can find a lot of real solid mid-cap companies kind of in that sweet spot of stability and growth in between large and small. And there's a look at the monthly chart on the mid-cap Spider ETF MDY, currently just trading a little bit below all-time highs. And for reference, there's the S&P 500, a bit more stretched and diverging more sharply. The Russell 2000 still hasn't made all-time highs back in mid-2021. But there did appear to be a bit of a buy the dip in the Russell 2000 today, just looking at the daily candle, putting in a hammer formation and signs of institutional buying on my indicator here, just like we got on the 5th of August. However, apart from the presidential debate, which I'll get into shortly, the biggest news event affecting markets today was the release of monthly inflation data, Consumer Price Index, CPI. Coming in line as expected, showing a 0.2% increase month over month in August, and actually coming in a touch better than expected year over year, 2.5% versus 2.6% expected. Core inflation month over month did come in a little hotter than expected, 0.3 versus 0.2. However, the data we just got confirms the trend in inflation is still pointing downward. We're now tracking at annualized rates under 2%. Good news is we've got food coming down. However, we've still got shelter quite elevated. And like I just showed you on the chart before, it did appear to upset the market early on in the day. At the very least, cause some volatility out there before the bulls came back and took over. And just looking at the reaction in bond yields, they did stabilize somewhat, coming off these really depressed levels of late. Bond market kind of sending a bit of a warning shot, pricing in swiftly lower rate just around the corner. However, I wouldn't really call it a bounce. There's the 2-year just kind of stopped going down just for today. Still way too early to say if we've seen a bottom or not. There's a look at the 10-year at 366 as well. Price action in high yield bonds still really good. We have had a bit of a creep up in high yield spreads over the last couple of weeks, but still overall long-term really low levels, 3.46. That action appeared to also help the US dollar stabilize, which has been showing signs of a potential short-term bottom here. But interestingly, Fed Fund futures market significantly pared back the odds of getting a 50 basis point cut next Wednesday, as inflation pretty much came in line and core was actually a little hotter month over month. And so since it's been a very fluid dynamic situation getting up to this point, say the Fed themselves have been deciding whether they're going to go 50 or 25. Once again, I'd agree with these odds from the market after today's print as well. I'd say it's almost a lock that they're going to go 25 next Wednesday. However, there is still a little bit of a possibility they could start big. But at this stage, that would largely be a surprise to markets. However, the Fed definitely needs to move. We've not only got softening in the jobs market, we are seeing a rise in bad consumer debts. They are creeping up. Charge-offs on loans to individuals haven't been this high in more than a decade, currently at 3%, something we haven't seen since 2011. We're also got a rise in distressed debt in commercial real estate. Just looking at monthly data here from March last year up until last month, we can see that acceleration, especially in multifamily, office, and retail, with all three categories having more than 10% of real estate currently labeled as distressed. And that's basically meaning they're late on paying their debt or they've stopped paying their debt altogether. Holding up the best, self-storage, not distressed at all. And just like bond yields, we saw crude oil hold ground today on the back of Hurricane Francine, disrupting a little bit of output in the Gulf of Mexico. Seen a number of key operators in the region shut down production. It's not a huge part of global supply, and the industry pretty much faces this every year, short shutdowns. So not a real big deal in the market. What's really been affecting it of late is softening consumer demand, both in the States and China. Crude oil technically oversold here in the short term, just got a reversal signal on the daily candle, potentially indicating the market could be finding support here at $66 a barrel. Also interesting to see today, agricultural commodities pressing up to multi-month highs. And something I'd also been paying attention to is uranium stocks, with the uranium ETF URA having a really good day today, up over 5% on strong volume off this support box. And there's a look at gold, still consolidating as it has been for a few weeks, just above 2,500 an ounce. We've got one research analyst, Ed Yardini, saying fallen oil prices could lessen the odds of a US recession, noting that cheaper energy reduces cost burdens in manufacturing, construction, and agriculture. And just like I said yesterday, oil, a really important part of the economy, literally greases the engine of the economy actually. When oil gets high, kind of acts like high interest rates, kind of restricts growth in the economy somewhat, and so does the opposite. Just when the cost of capital goes down, the cost of oil goes down, that can help stimulate demand and just make it cheap again to build and move things around the economy. And so there is a point there. There is a lot of overhead pressures on the price of crude oil. The first being the United States taking the lead and being the world's biggest producer, something that was kicked off in 2016 and accelerated in 2017, 18, and 19 up until 2020, kind of plateaued for a few years, then risen again to all-time highs. United States producing more oil than Russia and Saudi Arabia. You've also got the boom in AI and robotics, which is no doubt going to help production. You also got the growth of clean energy that is already softening demand for crude oil. And so all of these things could keep crude really cheap for many, many years, and that actually may be a good thing for the economy if we can get crude oil at $50 a barrel. And so it may not be as restrictive and as cyclical as it long has been. But by far and large, energy stocks are the weakest sector in the market. They have been for a few months. However, they too just did a big hammer formation, with also my reversal signals indicator firing off, DSI oversold, and similar price action in the biggest stock in the energy index, ExxonMobil. And energy stocks are still really cheap. For example, Exxon has got a PE of 13, dividend yield of 3.4%. And I'll be interested to see whether Warren Buffett's been buying the dip on Occidental. So once again, the mainstream media gets their way and the facts don't actually line up with the widely held perception. However, at the end of the day, it's perceptions that matter. Markets trade off perception, and that's what we saw after last night's debate. Betting markets actually flipping again, now saying there's the likelihood of victory for the Democratic presidential nominee. And that's why straight away during the debate, we saw stock indices come off hard, especially small caps, and Bitcoin didn't really hold into today's session like I just showed you on the market. We also saw a bit of a surge in renewable energy stocks. We also saw the parent company of True Social plunging as much as 18%, getting hit really hard, and the US dollar in the heat of last night was declining as well. And so at this stage it appears betting markets are given a slight favorite to a Democratic win. However, financial markets appear a bit uncertain. They initially reacted really negatively last night, but have somewhat stabilized and even recovered today. However, looking at key markets and spreads, it is overall negative. Here's a spread of small caps versus large caps, finishing down again today, but Bitcoin, which initially dipped as well, just like the Nasdaq, has recovered and seemingly hold on to ground. Market's not too upset that they're not going to be getting a 50 basis point cut. The rhetoric coming out from Oracle's Larry Ellison and Jensen Huang seems to have put in a pretty good bounce in semis here today. SMH reclaiming its 50-day, which was the clear winner today. Sector as a whole up over 5%. Looking across the rest of the market, it was pretty mixed out there. We also had regionals come off today as well. Similar move to small caps, not performing as well after last night's debate. But like I've said before, it's like the facts don't really matter. It's all about perception, and the mainstream media is pretty much all manipulating for one side to win. But to be honest, it's just kind of mind-blowing that all this government spending over the last 4 years, everything that's happened with the national debt being blown out the border, what's going on around the world, it'll be interesting to see whether most Americans who are suffering from the highest cost of living ever reflect that in their voting, and how that plays out across markets as well. Still got the US dollar testing support lows against the Japanese yen. Might have been a bit of a relief there. Now that it doesn't look like the Fed is going to cut 50 basis points, that could have set off the yen carry trade again. The Bank of Japan still saying they'd like to increase rates again if they can. And it's moving on to the story today of Atlanta's Fed's Bostic having violated trading rule, the watchdog says. An investigation found Bostic's trading activities breached the FOMC's blackout and trading pre-clearance rules, as well as the Reserve Bank's disclosure statement and prohibited holdings policy. He had securities transactions executed on his behalf during multiple blackout periods, didn't initially and accurately report certain transactions, and basically didn't stick to the ethical and technical requirements of personal dealing, being a Fed member. And it's interesting because he's not the first one. It's a bit of a culture at the Fed of sticking your hands in the cookie jar. We saw that coming out of COVID. Fed members were buying stocks in their own account just before we got the announcement of the Fed's largest, biggest ever liquidity injection program in late March 2020, setting markets firing to the upside. They also offloaded just before the Fed started indicating they were going to jack rates in late 2021. Two Fed presidents came under a lot of fire and criticism as it got leaked, the trading that they were doing. Of course, Jay Powell just let them retire early, as they say. Didn't want to fire them. That looks too bad, right? Instead, an early retirement sounds a lot better. So just like we see from members in Congress, they take advantage of information that you and I don't have. And when they get caught red-handed, they don't get locked up in a cage like you and me would. They just retire early with a golden handshake. And this is one of the reasons why empires crumble, from self-enrichment and corruption from those at the top, causes social unrest and a divide. And the big kahuna himself has even been accused of the same. Powell scrutinized for owning bonds of the same type the central bank bought during the pandemic. That was muni bonds. Powell's a big owner of them. He used the central bank's artificial money printing to buy those bonds, helping to stabilize the price. And how else is he going to be worth over 100 million if he's not used to bending the rules in his own favor, just like all his mates? So just remember, what he does is in favor of him and other 1% elitists at the expense of pretty much everyone else below them. And there's a look at the economic calendar for today. GDP growth in the United Kingdom actually coming in flat, lower than expectations, like their economy could be close to going back into a recession. There's the inflation prints from the States today. And looking out to tomorrow, we've got PPIs, jobless claims, into Friday, Michigan Consumer Sentiment Survey, and just getting back into the charts. Looking at breadth, that's still holding up pretty good. Volatility coming back down, VIX at 17, along with volatility risk premium still in positive territory though, indicating option dealers could still be seeing a little bit of volatility for the here and now. And we did get a bit of a sharp bounce back in growth versus defensive sectors, now sitting at the 50-day, along with a sharp bounce back in high beta versus low volatility stocks and discretionary versus staples, reclaiming their 50-day today as well. And maybe a bit of a sign that growth and risk is coming back to the markets. It was quite a bit of a turnaround after that whipsaw this morning. That, like I said, was led by one of the weakest sectors of late, but the leader of this entire bull market. The AI trade Chip semis, over 5%. Definitely trying to make a technical stand here. But either way, it looks like the market is bunching up, consolidating. We're still in this seasonally weak period that could potentially go on for another 8 weeks. We've literally got the election in 7 weeks from now. So like I've been saying, could still be a bit of a roller coaster ride up and down till that point. But we've still got really depressed bond yields and crude oil, and volatility still somewhat elevated as well. So market's still got a lot of work to do before we're back to blue skies again. Thanks very much for tuning in to Click Capital, and I hope to see you back again here tomorrow. Cheers.